On today's video, we are going to discuss our most talked about neighboring country, Pakistan, and the challenges it is facing. Pakistan is currently in the deepest economic crisis in its history. The 23rd largest economy in the world by purchasing power parity and home to around 230 million people is now facing a situation of complete economic collapse. Pakistan has been struggling to fulfill even the basic demands of its citizens. It desperately needs a few $billion to manage over the next few months. To give you a broad picture, a few days back, the general sales tax and the excise duty were hiked across the country. Petrol prices were raised by rupees 22 in Pakistani currency to around rupees 272 a litre. Petrol stations across the country are running dry due to reduced supplies by oil marketing companies. The country is facing close to 30% inflation rate now, and there is a breakdown of the supply chain which may cause hyperinflation in the coming few months. Meanwhile, the state of Pakistan has close to around $4.5 billion in forex reserves, barely enough for 3 weeks worth of imports. Recently, the Central Bank of Pakistan increased its benchmark interest rate, which is equivalent to the repo rate in India, to 20%, which is the highest since 1996. That means interest rates are rising rapidly to control the inflation situation. A World Bank report has revealed that more than 6 million people in Pakistan are currently experiencing acute food insecurity, and this number could actually increase in the coming few months. And Pakistan has recently initiated talks with the International Monetary Fund about receiving a financial bailout package. Now, what exactly is the problem in Pakistan's economy and how did it reach this stage? What exactly is a bailout package and will Pakistan be able to revive its economy? What lies ahead for our neighboring country and how can this affect India? We are going to discuss all these issues in today's video. Before that, a quick introduction about myself. I am Ayushi. I am an economist and have worked with the Government of India for the past 8 years. I have also had experience of working with the Planning Commission of India and have done my master's as well as my graduation in economics. This video is a case study on our neighboring country Pakistan, and I will be making more such case studies to help you understand how different economies function. Pakistan's economy has been unstable for a very long time. The difference today is that now it is on the brink of a collapse. This is similar to what Sri Lankan economy recently saw and in fact has been undergoing. This is a financial cum political crisis. Pakistan took several initiatives and policy decisions which were though in its political interest but not in its economic interest. And this has led to the situation we see today. Defense Minister of Pakistan has already declared that Pakistan has already gone bankrupt, and this is a huge statement. The country's economy has been pushed to a dangerous level due to several reasons. These include the following reasons which I'm going to discuss on today's video. First is debt. Now, I have maintained that debt per se is not a problem. If debt is being taken to build assets which generate return for us and we are able to repay that debt, then there is no issue at all. It applies to individual as well as the economy as a whole. However, if we keep on taking debt with no long-term repayment plan, then this is a recipe for disaster. During recent years, Pakistan has found itself stuck in a cycle of rising debt without a long-term repayment plan. Debt comes with the principal amount as well as the interest. If you see this figure, Pakistan's debt to GDP ratio stood at 87.6% in 2020. According to Indian Strategic Affairs Specialist, Mr. Sushant Sareen, Pakistan has doubled its debt roughly every 5 years over the last 25-year period. Starting from a debt of around rupees 3 trillion at the beginning of 1999, the debt stood at rupees 62.5 trillion at the end of 2022. More debt was being taken to clear the previous debt, and hence the government entered into a vicious cycle of taking on more and more debt with no plan on how to repay it. So you're taking debt to clear the previous debt and you're taking more debt to clear that debt. This is called as evergreening of loan in economics. While the debt was growing at 14% every year, the GDP was growing only at 3% every year, which led to an unsustainable debt burden. In the fiscal year 2022 to 23, the debt servicing obligation has exceeded the entire central government revenue. Let us understand this increasing rate of debt vis-a-vis the GDP with an example. Let's say that the GDP of a country in a fiscal year was 100 rupees. Let's also say that the debt taken by the country in that fiscal year was 100 rupees. Now, if the debt is increasing by 14% and the GDP is increasing by 3%, then by the next year, the debt will be rupees 114 and the GDP will only be rupees 103 in the second year. Now, the debt continues to rise at 14%, but the GDP is rising only by 3% year on year. So, in the third year, the debt is going to be around 130 rupees, while the GDP will only be around 106 rupees. Can you see that the gap between the debt and the GDP continues to rise? And this creates a problem because you are not generating enough income to repay the debt. That means that there will be going to be a situation where you're going to default. And similar thing happened with Pakistan. Pakistan is on the verge of a default. It cannot pay the debt it has undertaken in the last several years. Right now, Pakistan's debt to GDP ratio is in a danger zone. Imagine that 40 to 50% of the government revenue has been earmarked only for interest payment this year. According to a recent report, out of Pakistan's total external debt, around 20% has been taken from China itself. First, understand that we need foreign exchange to trade in the global market. If a country imports goods and services, it has to pay through its foreign reserves that it has collected. In January this year, Pakistan's foreign exchange reserves dropped to $4.4 billion, the lowest since 2014. With foreign exchange not being released, containers carrying food and raw materials are not being cleared at the ports. Some of the biggest companies in Pakistan have actually halted their operations as they have run out of raw materials or foreign exchange, which has compounded the troubles of the economy. For example, the local unit of Suzuki Motor Corp extended the shutdown of its manufacturing plant to end of February, saying that there was a several shortage of parts and this has led to closures. Now, these closures are also going to impact the economic growth of the country and is also going to lead to higher unemployment levels in the country. So this is again a major issue. Now, the third issue is inflation. Pakistan is seeing the highest inflation in a 48-year period. The government of Pakistan has been unable to keep up with the import demand, and inflation in the country was at an all-time high in January 2023 as thousands of containers of food items, raw materials, equipments, machinery were stuck in ports. The government can no longer afford to pay for the imports. Moreover, the devastating floods which Pakistan experienced last year, which also killed around 1,800 people and left over 2 million people homeless, caused a heavy economic damage to the country. Some of the estimates say that $14.9 billion worth of damage was incurred and $15.2 billion of economic losses were seen. The immediate causes of the floods were, of course, natural causes, and that cannot be averted to a very large extent. But these natural disasters have also created a major problem for an already affected economy. The disruption of the economic cycle due to the floods also disrupted the supply chain and led to a rise in the price of goods and services. But what does inflation really do? It, of course, affects common people like you and I when everything becomes expensive for us. However, higher inflation also tends to have a depressing effect on the value of the country's currency. This means that inflation reduces the currency's buying power, which means that the country's currency will be weakened against other currencies of the world. And that is the fourth concern of the country, the Pakistani rupee. Pakistani rupee has fallen to a very low level. As per the country's central bank, the Pakistani rupee fell 9.6% against the dollar. Now, when the currency of any country falls, it sends a negative response to the investors across the world and can actually lead to a situation of money outflow from the economy where investors start pulling their money back, which can again lead to a situation of lowering of forex reserves. So if you see, all these problems are actually interconnected. These are all economic problems. Of course, natural disaster is one such problem which affected the economy as a whole and the lives of people there. But all these economic problems are interrelated. So the fifth problem is the political crisis in the country. It is believed that constant political chaos has actually undermined a coherent and timely policy response which the country could actually have initiated. In fact, while doing research for the video, I got to know, and I was quite surprised by it, that no Pakistani Prime Minister has completed a full 5-year term in office in its 75 years of independence. The recent ousting of the Imran Khan government and then the continued political instability has posed a challenge for the country's economic future as well. What one needs to understand here is that politics and economics of any country are intertwined and closely interdependent. If there is a political unrest or instability in the country, then the economic growth of the country is also going to take a beating. Simply because with political uncertainty comes ineffective policy formulation, lack of vision, and public's lack of confidence in the government. And this hampers the economic progress of the nation. The sixth point is related to significant shortage of power and energy. Pakistan is a highly import-dependent country, particularly with regard to energy. This means that it is acutely vulnerable to hikes in global oil and gas prices. So the Russia-Ukraine crisis and the increase in oil prices also contributed to this situation of the country. It has enough installed power capacity, but it lacks the resources to run its oil and gas powered plants that are heavily in debt and cannot afford to invest in infrastructure and power lines. And with shortage of power comes other problems. A lot of companies, which includes manufacturers of fertilizers, steel, textiles, they have shut their factories indefinitely or at least suspended their operations because there is lack of power and energy. In fact, according to a report, the crisis has actually forced the government to order shopping malls and markets to close by 8:30 p.m. for energy conservation purposes. The power shortages and the outages is going to hamper the domestic and industrial output and its competitiveness in the global markets. Some of the power infrastructure was built as a part of the China-Pakistan Economic Corridor, which is a framework for regional connectivity, and I'm going to discuss this as a separate topic in my subsequent videos. This infrastructure has reportedly added to Pakistan's debt as the country cannot even operate these corridors now. The seventh and major factor is about Pakistan's tense relations with India. Strained ties between Pakistan and India have continued to deprive Pakistan of a potentially transformative trading and investment partner. According to a recent report, the total bilateral trade between India and Pakistan was around $330 million in 2020-21. This has gone up to $514 million in 21-22 as per the Ministry of Commerce, with Indian exports outnumbering imports from Pakistan. Thus, Pakistan being stable and with a good economic condition is also in favor of India. And India can act as a supportive partner for Pakistan's bilateral trade relations. Thus, as a conclusion, food and fuel price hikes are causing real pain to ordinary citizens. The central bank has raised interest rates sharply to address the growing inflation in the country, and there is a weakening of investor confidence in the country. All these are contributing to the economic woes of Pakistan economy. But the question now is, how much money does Pakistan actually require? According to a few estimates, the country needs $20 billion over the next 12 months to make payments arising only from debt obligations. Pakistan's former finance minister has said that Islamabad might be better off just going to those countries that we owe a lot to, or to the institutions that we owe a lot. That means that try to get some more long-term loans from the country that Pakistan already has taken loans from. But the point to be kept in mind here is that long-term loans come at a cost. For instance, if it borrows from its neighbors like China or Saudi Arabia, they would be looking to further their geopolitical interests in the region, and this could be detrimental to India. IMF is also likely to demand significant belt tightening with regards to its expenditure and imports in the country. So, what exactly is a bailout package? A bailout package is nothing but a financial loan that is given by a particular institution or a country in order to help with the debt situation in the country. This comes at a cost with its own terms and conditions, which can actually affect a lot of countries, not only the country which is being affected by the debt, but also its neighbors. The final point, but the most important point here is, should India worry? There is a mixed opinion on this particular issue, and I would love to hear your opinions also. So please do comment them in the comment box down below. With the long-standing on and off tensions between India and Pakistan, a lot of commentators and even former ambassadors to the country hold this view that economic crisis in Pakistan is of its own making, and therefore they should be dealing with it on its own. However, one also needs to keep in mind that an unstable country can destabilize an entire region. The economic crisis which our neighbors like Pakistan, Sri Lanka and Bangladesh have been grappling with can actually affect the entire South Asian region. And the problem can go beyond the economic crisis. In case the problems of inflation and unemployment continue to increase in these countries, a lot of people would be forced to take desperate measures. This could result in a rise in radicalism, terrorism, or the refugee problems, especially with our neighbor country, Pakistan. And this is going to affect India adversely. Moreover, it is speculated that the deep economic crisis in Pakistan might actually increase the Chinese influence in the country. This might directly or indirectly affect India as well. So, India needs to weigh its options very carefully before deciding whether or not to step up to help Pakistan at this hour of need. What do you think about this issue? Please do let me know. I would love to hear your comments on this issue because this affects India to a very large extent. On this note, I am going to close today's video. Pakistan has never been an easy country to deal with, but since whatever happens in Pakistan also affects India, we need to be prudent about and we need to be aware about what is happening in the country. I hope that you like this video. If you did like this video, do press the like button and subscribe to the channel. I'm going to make more such case studies for you. If you want me to make a case study on any particular country, please do let me know in the comment box down below. I read all your comments and I really appreciate them from the bottom of my heart. Thank you so much. See you the next time. Bye.